got perspective on oil. In its latest note, Jefferies has downgraded earnings estimates for graphite electrode manufacturing players like HEG as well as Graphite India. Let me take the cross to Ashesha and find out what's the rationale behind the same.
Oh yes, so Jefferies has retained a buy rating on both these counters, Graphite as well as HEG, but they've revised the target price. As far as Graphite is concerned, the revised target price now stands at 565 rupees per share, and for HEG it stands at 1760 rupees per share. They've cut their EPS estimates by 4 to 6%. The reasons are quite obvious. The companies have been facing input cost pressures, needle coke, energy prices, freight prices have gone up, and that's the reason input cost pressures have been weighing on the margins of these companies. Volatile commodity prices are also weighing in because graphite is ultimately used for manufacturing of steel, and steel prices have been volatile of late, and that's the reason Jefferies has actually cut target price on both these counters. As far as the quarter gone by is concerned, demand moderation was globally impacted because of geopolitical crisis and supply chain constraints. Graphite India and HEG's capacity utilization, however, stood at 90% for January to March quarter. As far as price hikes are concerned, they stood at around 12% on a quarter-on-quarter basis in quarter 4. And going forward, HEG management expects around 5% quarter-on-quarter hike in this quarter as well. As far as decarbonization is concerned, it is a big tailwind for the sector. In production of steel via EAF, carbon emission is lower by 4% as compared to the traditional blast furnaces, and this poses a good opportunity for the graphite sector. As far as capex is concerned, HEG is adding around 20k million ton capacity, which is expected to be commissioned by early 2023, and this new commissioning could support volume growth over the near term. However, as of now, Jefferies has cut target price on both these counters, graphite as well as HEG.
Ashesha, we'll leave it at that. And